What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is April 12th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we've got a jam-packed episode where we're not only going to be diving into our thoughts on the recent moves in Bitcoin's price over the last 2 days, but on top of that as well, share one of our key Bitcoin metrics that we're watching that can help us to spot temporary tops in markets, as well as diving into the volatility index, equity markets, and the inevitable focus point that we need to discuss, which is inflation. The numbers are going to be dropping later on today, so I want to spend some time to talk about expectations and what we genuinely think is going to happen. So we've got a lot of things to dive into in today's video. If you guys happen to enjoy my rambling, consider dropping a like. It's one of the best ways you can support the channel, and let's go ahead and kick off the rambling. All right, so I want to go ahead and start here by talking about Bitcoin. Bitcoin has yet again charted towards new relative highs here, pressing up against that big even level at around $30,000. As we have discussed before, since we really started to kind of hold around this range at 23K, it's not out of the question that Bitcoin during this relief rally could come up to 28 to 32K. This was a significant price range. If we take it back to the weekly time frame, not only back during the period of time during the correction in May of 2022. This is where we had some temporary support, temporary resistance, but it was a very significant range, and likely so because of the fact that we had previous support back here between May to June or July of 2021, as well as January, before we continued onward towards testing the initial high range of the cycle around 65K. So this is going to be a range of contestment, of chop, where Bitcoin is going to have to really prove itself as to whether or not it's going to be able to kick off another bull market. We are definitely above the 200-day moving average, the 200 weekly moving average. All these things are signaling a lot of confidence for the bulls, and the question is whether or not on a week-by-week basis can we continue to maintain that market order flow? Can we continue to make a positive trend upwards? And are we going to have the bid side support to be able to hold us there until we get that that market order flow? And if not immediately, are we going to be able to have that strong bid side support that can absorb that market order flow sell pressure in the meantime, allowing us to really kick off another bull market? That's going to be the ultimate question here. Now, I want to go ahead and share one chart here. I don't want to be too bearish, guys. It's definitely awesome to see Bitcoin chartering higher here. It's great, definitely, for the bulls. The big thing I want to talk about here, just to be cautious, as we discussed back in one of our previous videos, I think it was sometime last week, we discussed the Bitcoin market dominance indicator. I really want to drive this indicator home here because this is allowing us for the last 2 years to be able to spot when Bitcoin dominance is getting overheated and when sellers usually come in. The last few times we entered in between this range of 47.25% all the way up to around 49%, this is usually when Bitcoin starts to chop lower. Essentially speaking, Bitcoin itself has been leading this rally. Altcoins are doing subpar. Some are doing better than others. More defensive ones like Ethereum are holding up okay. But even in the ETH to BTC ratio, we can see that Ethereum is severely underperforming against Bitcoin. It's been doing so since as far back as September of 2022, during that period of time, during the last relief rally. So this has really been a Bitcoin rally here. And the question is whether or not Bitcoin will be able to continue here. Some people believe that is the case due to all that's going on in the macro environment, distrust in the banking system and the dollar and treasuries. But to be honest with you guys, you know my take on it. While there has been this narrative for almost a decade or multiple decades now that the dollar is going to imminently collapse, all these kind of hyperbolic Bitcoin $1 million predictions, this is the kind of stuff that can lead towards exuberance and short-term irrational rallies in markets where valuations get way ahead of themselves. And even if we have found our bottom back during the period of time, back a couple months ago during the FTX collapse in November, it doesn't mean we can't come to retest that range or near it, right? So I just want to make that clear. We are still of the idea that we are going to come down and at a minimum retest that range or go down to new lows. All I'm saying here is that while that is our bet here on the channel, and that's the strategy we're going off of, considering the severe macro conditions that Bitcoin is going to be facing in a high interest rate environment, and a tightening and contractionary environment, and likely during a recession. At the same time, we have to see how it's going to play out. All right, that's just where we're putting our bets here, and we'll confidently say that here on the channel because I think you guys come here for me to give you a clear, direct opinion on where I think's going. I'm not going to just say it could go this way or it could go that way. Sure, it could go either way here. I want to make that very clear, not to speak in absolutes, but we do believe that Bitcoin is going to come lower. And I'm going to go ahead and talk a little bit about why we believe this is. There are a couple key things we need to discuss. First off, we need to talk about equity markets. The NASDAQ, which should be leading forward, setting new highs like Bitcoin, relatively speaking, is not doing so. Since back during late March, we've continued to move lower here, starting to fade gains on the weekly time frame, and it's looking very similar here to what we've had in the past. A relief rally for a certain given window of time, a couple of months at a minimum, usually around 2 to 3 months. In this case, we've been doing so since the start of the year, so it's been about 4 months worth of price action. But yet again, we have not been able to get above where we were in August or where we were in March of 2022. Now again, these technology stocks have made up the vast majority of the returns here. More specifically, a couple large conglomeration of stocks such as Nvidia, companies like Apple, Microsoft, Netflix, Meta, companies that right now are not proving any massive innovation, but are rather saying, oh, we're cutting layoffs. We're starting to engage in layoffs, so we're cutting off our employment base, we're cutting costs here and there, and therefore we're going to stomach the recession. That's the only narrative that I've been hearing outside of AI, right? And AI, again, as you guys know, I don't want to beat a dead horse here. We're very excited about AI in the long term, but even if you're excited for something over the next 10 years, doesn't mean that the market is going to be pricing it in long term, or that the valuation increase we've seen is going to be able to hold when it comes towards the things that really make up Microsoft's valuation. OpenAI is less than 2% of that valuation. So again, when you're talking about the fundamentals, when it comes to its financials, those quarterly earnings reports, one of which is coming up soon, can definitely bring a wrench into those plans, right? So the big thing here I want to talk about is going on to the VIX here. Now again, we have said it time and time again. We said it back in January. We didn't know what was going to happen here, but we ended up getting a whole slew of different banking companies going under here. A lot of the small, medium-sized banks that are managing billions upon billions of dollars of assets. That was what really drove us higher here. But at the end of the day, guys, I'll be completely candid in telling you something that I think a lot of other people won't tell you. No one knows 100% what's going to happen in the future. And more specifically, if there are going to be some catalysts that do drive a recession, even the one that we're calling for here, I'll be honest, there's a couple things I could point you to. I could point you towards what's going on in the REIT market, the real estate investment trust market. I could point towards all types of different things, whether it be the banking system or what's just generally going on with consumer sentiment, considering inflationary pressures are the number one focus of the Fed, and therefore interest rates are going to continue climbing higher, which increase the cost of capital. I could point towards a lot of different things, and you guys might also have your own opinions on what's going to cause it. Case in point, though, I want to talk about the VIX. The VIX is going to let us know whether or not we are in a long-term bull market, if we're at the beginning of a new bull market, or if this is just another relief rally. Now, the VIX has been building up since as far back as 2017, around here in November 2017. It has been an over 5-year, coming up on pretty much 5.5 years, trend to the upside with higher lows. Ignore all the noise here. What I care about is the long-term uptrend in volatility, the new foundational highs on the support line for the volatility index. This measures the volatility in the call and put options on the S&P 500. And generally speaking, when volatility moves up, equities are setting up for a big move to the downside. Volatility usually spikes and increases. It is contractionary, or more specifically, contradictory to volatility. It means that equities are going to likely move lower. Asset prices will likely face downside pressure during a spike in the VIX. So as we're kind of building up here towards our consistent resistance range, which is around 34, 35 points on the VIX, and we're continuously setting in new highs, question remains not about what's going to break the financial system. The real question is, when are we going to see it? And I got to tell you guys, the more we get close here with these higher lows and this consistent resistance range, it's letting me know that something bad is going to happen here. And to be honest, it doesn't mean a collapse of the entire financial system, but it likely means an earnings recession. People starting to severely reprice equities and considering the current status of consumer sentiment, available cash flow in the economy. And trust me, I know a lot of people would say this doesn't have any stakeholding on Bitcoin because Bitcoin is just Bitcoin. It doesn't have earnings reports. It is completely subjective in the eye of the beholder. Guys, it does matter because if people in the economy have less disposable income, right? That's the kind of income where if people lose it, it's not the end of the world. It's money that goes into the savings or is something that essentially is external from the money that people need for everyday goods and services. If people are struggling to pay for their everyday goods and services, they don't have disposable income. If the government isn't printing stimulus checks like they were in 2020, people do not have more disposable income. And the question we need to ask ourselves here is whether or not at a 30K price tag for Bitcoin, this can really keep going towards 60, 90, 100K like it should in a bull market, which is what everyone is, I think, hoping for here if someone's already positioned in Bitcoin. Can the market really do that? Really just think about it here, right? I don't want to be a monolith of opinion. I'm not trying to speak in absolutes. I want you guys to think about that for a second. I want you to be thinking in a more cautious mindset rather than an overtly optimistic mindset. Really think about it for a moment. Does this speak of a healthy market, growing uncertainty in equity prices? How about the yield curve inversion, right? And one thing we're watching for here is on our momentum indicator when we get the blue flip on the monthly time frame. And with the spike we saw back in March and us holding relatively well here in April, this is likely going to tell us that we're at the beginning of the end of this recession, right? Where we're going to start to really see the pain coming in. The problem about recessions is that for a year, usually before the recession, this is the same in 2007, there were blips here and there that got people a bit concerned, but a lot of people, after we started to see a relief rally in price, started to feel, oh, everything's back to normal. We're kicking off the next bull market. The perma bears have been proven wrong. But at the end of the day, there are periods of time, and they usually last for multiple years, where the bulls are right, i.e. bull markets that can go on for 7 to 10 years, like the secular bull run we saw back during the period of time between 2009 going towards 2022 or 2021. And now we're in a period of time where the bears are going to be probably right for a shorter window of time, for about 3 years. That takes us into 2024. And that is not a pretty picture here if you're looking to buy Bitcoin. When we start to see the yield curve moving up and we get that blue flip on our momentum indicator, that takes us towards periods of time like November of 2000, the peak or near peak of the dot-com bubble. It takes us to periods of time like March 2007, when equities had started to bump up a little bit. People didn't really see that there was systemic risk, and then we had the housing crisis, 2008. We may not know exactly what it's going to be, but our indicators are certainly signaling something is wrong. And this takes us here towards today's inflation data. Now, if you guys haven't already, we've been talking about it for weeks here. Back just really a couple weeks ago, it's amazing how the narrative gets lost sometimes because people are always constantly chasing, oh, this is the reason the Fed's going to pivot and it's going to stimulate asset markets. Everyone's kind of pulling for straws essentially and trying to figure out why the narrative is that equities are just going to keep going up, because that's what a lot of investors want. We talked weeks ago about how the Fed prediction markets were already signaling a 50% chance of a Fed rate hike. And that was already enough of a concern here that likely tilts us into believing that the Fed has been able to contain the contagion in the banking system and is going to continue tightening because inflation, cooling inflation is its number one goal. And if you look at those numbers now, you're talking about 70, 75%. 3/4 of the market is now confident that the Fed is going to raise the federal funds rate by another 25 basis points, contracting credit even more because of the fact that they are still at the moment expecting month-over-month inflation increases of 0.3%. Imagine the average spending you're going to do as a consumer from February to March. These are going to be the March numbers that come out. In a matter of a month, moved up 0.3%. That is not healthy. And that's the expectations. If we get a breakaway from that, that's going to be a really big concern. But I want to go ahead and highlight what really matters here. It's not so much the CPI here when it comes to it is an inflation metric, because to be honest, sometimes it can move higher, sometimes it can move lower quite significantly because of energy prices, which are a little bit more volatile. But what we've been focusing on is the PCE, the core inflation. And this really has been showcasing that inflation is going to be sticky while the CPI blasted towards higher levels around 9% and has dropped, or is expected around to drop here towards 5.2%, getting a pretty nice haircut here from the annualized data. The key thing we need to focus on is that PCE. If home prices, rent, a lot of the core expenditures that people are facing don't start to cool down, the Fed has not done its job yet. That is a huge part of consumer spending. And if there is not a better equilibrium between supply and demand, that inflation is going to remain for a long period of time. And the Fed likely means that the Fed needs to continue increasing interest rates. They need to, at a minimum, get up to that target 5.5%, or 500 to 550 basis points. This is what we've been talking about for nearly a year now. It's coming up on almost a year. We've been talking about it since the last summer, back in around June, July, and August, that the Fed is going to have to keep tightening. This is not something that you can just turn away from, manipulate the metrics, so many of the things that we were told over the past couple months. It's going to be a brutal awakening, guys. And to be honest, we'll have to see how Bitcoin reacts in that environment. I can tell you guys, equities are not going to respond positively to it once the AI mania starts to wear off. And people realize that while it is a great technology, it's not 100% there to reach all of the promises and increased valuation in Microsoft or Google or companies associated with like NVIDIA that are making graphics processing units. It's not enough to keep up for the demand. We are going to see that slowly seep into reality here as we start to get these inflationary metrics. And when we start to see earnings reports coming out that are proving otherwise from the narrative. And one last thing that I want to talk about here on this topic of inflation. One thing to keep in mind here, if you guys are hoping that energy markets are going to be the kind of savior for the CPI and lead us towards lower numbers, take a look here at what's going on in oil. Oil's price has spiked up since back here in mid-March. We've rallied from around $65, $66 a barrel all the way up here towards 81.7, pushing back up towards that 200-day. We have highlighted for, again, going back over the past couple quarters here, we've talked about how the 200-day and the 200-week would be this center point for oil, this kind of squeeze and coiling of price action. And until we really get a definitive break on either direction, we are not out of the woods here with inflation. Until we get a severe collapse below that 200-week, the bulls cannot be too confident that inflation is done with. Oil has such a huge component when it comes to the cost of other goods and services. Everything you're talking about outside of really housing prices, which can be affected by energy, but more specifically, you're talking about all consumer goods and services. If oil starts to break back up into upper double-digit territory, into that $90 range, and it starts to move up especially into triple-digit territory, that is going to be your sign to run for the hills, to be long dollars, to be long treasuries, to be long defensive assets, not speculative assets like stocks, and more likely than not speculative stocks or assets like cryptocurrencies, even Bitcoin. Because at that moment, the Fed is going to have to hike even more aggressively. It will have realized that this slowdown and the increase of rate hikes was a mistake, and that they're going to have to play catch up even harder. That is the reality of inflation. It is not a fun one, it's not convenient, but it is something that, again, at the end of the day, is the Fed's number one mandate. And if they don't get on top of it sooner rather than later, it is going to be a lot more damage down the line. So, anyways, guys, I've rambled on a good amount here today. Whether or not you guys agree 100% or not, I hope you guys enjoyed this video. Hope you got something out of it. If you guys did enjoy this video, consider dropping a like. It's one of the best ways you guys can support the channel here. And I think the biggest thing overall, again, I want you guys to be just prepared for here is to not chase in to any emotions you may be feeling, but rather try to think about this in a logical way. If you guys decide to buy or decide to trade Bitcoin, hey, it's totally fine. As we've emphasized here for weeks upon months here on the channel, it's okay to do a bit of dollar cost averaging. It's okay to have some exposure. We've got a little bit of crypto exposure. May not sound like it, but we do. And you guys can get access to what kind of exposure we have within the Dash Report. It's our newsletter here on the channel where we talk about crypto markets, equities, we talk about commodities, Forex. We have a ton of trade setups that we are looking to engage in, betting on price going down here in the near future. We just opened up a trade yesterday. It's the start of probably a multi-week trade that we're going to be doing in the month of April, potentially into May, where we're hoping to make some really solid returns. And it's not just stuck on focusing on the crypto market. There are a lot of opportunities out there that we can capture. And you guys will also get access to those momentum indicators that you guys have seen, the red and blue line indicator, if you guys check out the Dash Report down at the link down below. And you guys can get 20% off if you guys sign up for an annualized newsletter. That's it for today's video, guys. I've been rambling on a good amount here, so you can tell I'm still a little bit sick, so apologies if I stuttered here and there and everything. I'm hoping to get better over the next couple days. Hopefully I'll be good by the next video. Until the next one, though, thank you all so much for watching, and I'll see you all in the next one. Take care, everyone.